So for those who don't know me yet, my name is Bennett Stein, and I've been in crypto for about 5 years, and let's talk about how to make money. So what we're going to be talking about is my beginnings as a trader and as a YouTuber, why crypto, and we're also going to be talking about some skills that we can build. All right, why are there needles on the screen? Well, I had a life shock in 2017 where I was diagnosed with type 1 diabetes. It's where your pancreas just doesn't work as well as it used to. How is this relevant? Well, it really forced me to go a little less traditional. I was planning to go into corporate finance and to do hedge funds and become just like Damian Lewis on Billions, if you've seen the show. That didn't end up happening because I thought it'd be a lot more interesting to go my own route. I'm really interested in psychology and risk and economics, and crypto is a merge of all three. My first YouTube video on my channel was absolutely awful. You could barely even see the screen, but one good thing did come out of it. The first YouTube comment, guys, I ever got was this. So Suburban Nightmare was the first guy or girl. And unfortunately, I don't think he's part of the crypto community anymore. Maybe he became a rapper, or maybe he's still, smoking or something, but cool comment. All right, what will you learn? We're gonna be talking about what moves crypto markets and how you can make money from it. We're gonna change your view on risk and how you take risks, when to, when not to. Understand your emotions when money gets involved, and you're going to learn from the successes and failures of me and of others. Why do we trade crypto? It's a highly volatile and a highly emotional market. If you can't control your emotions while you're trading crypto, you're going to be the one buying the top and selling the bottom. But if you're able to understand the emotions of other people and how that impacts a market, that's where you can potentially make some money. It's accessible 24/7. Unlike stocks and commodities and other markets, there's never going to be a time where crypto is not up. So as long as it's not the end of the world, you can trade crypto. There's also an abundance of avenues for profit, and this is my favorite point. If you like art, there are NFTs. Speculative, but they're there. If you like DeFi, you can do DeFi. If you like arbitrage, you can do that. There's so many different ways you can make money that you shouldn't just constrain yourself to just one way. Now, what I'm going to be talking about in this presentation is I had the choice to go pretty broad or to go very specific and lose all you guys, but I'm choosing to be quite broad. So we're going to be talking about just the general strategy of how I view the market and how I think you should probably view the market too. A typical thing that people say is to buy low, sell high. Good advice, but honestly, it's not going to get you that far. Because what's low? I mean, what's high? Imagine you bought Bitcoin early. And when you bought Bitcoin early, you sold it at 18,000, right up there. Now Bitcoin's at 11,100 in this example. Is that low? Is that high? Should I buy there? Yes or no? If you did end up buying, bad news. Price went down to 3,200, a 70% price drop. So just simply buying low or buying lower than where you had bought before is a pretty bad strategy. There's another strategy that is a lot better, which is what we're going to talk about. However, if you guys are looking at this chart right here, not knowing what the price of Bitcoin is, would you buy at 3,200? There's only one answer for this. Yes? Well, whoever said yes got to buy first. The rest of you didn't buy. And the person who said yes just made 20 times in their investment. So whoever did that, now you made quite a large amount of money. All right, now the first example of how I approach strategy. I'm going to put you guys in a scenario, and you're either going to lose or make a lot of money in your mind. Imagine that there are 99 other traders in a room with you. Every trader can either buy or sell a coin. Now on this, if a trader buys, the market moves up by $1. If he sells, it moves down $1. Now imagine that every single trader in this room has just bought except you. Everyone. And the only people trading are in this room. Now here's one you have to answer, because there is a right answer, and it means a lot. Would you buy or would you sell if every single person has already bought? What do you think the better thing to do is? I'm hearing some murmuring. You could be more confident. Say it louder.
Sell.
Exactly. Sell. Okay, 100% correct. Sell. Well, why? Why is it so important to sell? Well, really, if every single person has already bought something, can a market rise in that example? No. The only way the market could rise is if you buy it, and then once you buy, no one else can buy anyway. You bought the top. If you notice that every single person has bought something, or every single person is talking about something, that is one of the worst times possible you could buy. Awful strategy. What you want to do is you need to buy when people are pessimistic or not really talking about something. That's when you actually get it at the ground floor. Because in a market, I don't want you to think about buying low and selling high. No, don't think about that. The most important thing for you to do is to buy before others buy and to sell before others sell. Any way you can do that, you're going to make money. If you ignore that fact, you're going to lose money. Now, the market is an emotional cycle, and you've probably heard this statistic before, but it is true. 90% of traders who put money into a market in the short term are going to lose money. There are a lot of reasons for this. Fees are one, but emotions are a big part. Bull markets are born on pessimism, grow on skepticism, mature in optimism, and die in euphoria. You guys are probably like, what the fuck does that even mean, right? Well, what it basically means is that when a price begins to trend, this is the cycle that tends to happen. When people are very pessimistic, that's the ground floor. Then, as the market begins to rise, people become skeptic. Oh, why is it rising? It's just going to fall. As it continues to rise, people become a little bit more optimistic. And when they get a little bit more optimistic, you get to around this stage right here. Then you get euphoria. Euphoria is what happened to Dogecoin when it hit 70 cents and went on SNL. And a lot of people rushed in, bought Doge at an awful price. And what ended up happening is they bought it because they were hearing about it. But by the time you hear about something, it's probably better to sell. Now, if you want to be part of the 10% of people that do make money, you got to find a way to do the opposite of what the 90% are doing. Because if you do just exactly what everyone else is doing, you're going to get the result that everyone gets, right? And if most people lose money, what result do you think you're going to get? This is something that I want to show you guys that I find absolutely fascinating from a psychology perspective. What you're looking at is this is the price of Dogecoin in the candles. You guys can see the price and numbers, right? Up here, we see Google Trends. So this is how many Google searches there are of Dogecoin. Look what ended up happening at point number 1, which is right here. Price rose to a top, and that's when everyone started Google searching it. So that's probably when you began to hear about Doge, which was in February, late January. If you had bought, you would have bought at a pretty bad price, because price ended up falling by about 40%. But here's where things get interesting. Look at point number 2. Almost no one was talking about Dogecoin. Almost no one was Google searching Dogecoin. And what ended up happening? That would have been the absolute best time to have bought. The best time to have bought is not when everyone's searching it. It's not when everyone's talking about it. It's when no one's talking about it. That's where you can get it very, very cheap. And if you had bought there, you would have bought it about 5 cents, and it went up to a high of 75 cents. So you would have made at least 15x. Now, the most important part of this chart is number 4, because that's, I believe, when SNL occurred and Elon Musk started to talk about Doge, and everyone here probably heard about Doge around then. It was like the Squid Game back then, you know? So what ended up happening is if you look here, the market was very euphoric. It was just spiking so much higher, doubling. And you could see Google searches hit an all-time high for Doge. It's going to be hard not to buy in that kind of situation, because what you're going to end up seeing is Doge at 65 cents, and then 66 cents, and then 67, and everyone who's new to markets, they want to buy, naturally, because they're like, oh, I'm missing out. And it's that exact emotion called FOMO, fear of missing out. That is how you'll probably lose the largest amount of money if you do choose to trade markets or to invest. Now, what could you have done to completely avoid this? If you're advanced, you could try to bet against the market, meaning shorting, or just betting that the market will fall. That's one thing you could have done. The other thing you could have done is wait for this. If if you look here, just about no one was searching Dogecoin, no one was talking about it on the internet. And price was right down there because there was really no interest. That would have been a great time to invest. That would have been a fool's investment. And the only thing that's different is how many people are interested and how many people are talking about it. So basically, in the advanced level, even at the beginner level, you gotta become a market contrarian. And here is the example. Back to the thing that I really wanna hone into you guys. If you guys can remember one thing, it's buy before others buy and sell before others. There you go, good. So a surge in Google searches of a major crypto tends to signify late buyers. If your grandma calls you and asks you if she should buy Doge, what do you think you should do? You should sell. Because by the time that that information has hit your grandma, the market's at its top, and she'll be the last buyer. So you know what you should tell her to do? Open up a short and profit and move to the Bahamas. That's what she should do. Not many Google searches tends to signify a lack of buying. Now, if we bring this back to the framework from earlier, when every single person in a room has sold something, who's going to make the most money? The guy that buys first. Because the guy that buys first buys at the bare minimum. So if not many people are searching, not many people are probably buying or trading it, you might be able to become the first person. And that's why what Ryan had mentioned too, it's really important to get on the ground floor and to do your research so that before these things become everyone on Twitter and everyone on Google and YouTube talking about something, you get in early. I have an absolutely fascinating 2-minute clip for you guys. I've seen this probably 20 times, and we'll see if you guys will fare the same with how the experiment went. This, basically what you're about to see, can describe every single cryptocurrency at one point or another. They did an experiment of similar to what we had just talked about traders in a room who can buy or sell an asset. Except this asset, essentially what you're about to see, is there's an asset and all of the students who are participating are told that this asset is going to fall to zero at the end of the experiment. But they still trade it at strange prices, and you'll see why.
In this experiment, Smith wants
Can you guys
to see
hear it?
what happens when students compete to earn money on a simulated trading floor.
You have to strain your ears.
It's not a classroom setting. It's a setting in which your job is to make as much money as you possibly can.
If they play the game well, they could earn hundreds of dollars.
This is real money, serious money.
Each of them has been given an imaginary financial asset to trade. And right from the start, they're told to be careful because the asset will decline in value over time. By the end of the game, it will be worth nothing.
The asset will live exactly 15 periods of trading. And the question is whether this will determine the prices at which they exchange or whether the prices at which they trade deviate from that.
Okay, the experiment has begun.
On the screen, they see the prices the other traders are offering to sell or buy at. And they also see the value of the asset as it relentlessly declines. Shown here is a dashed black line heading downwards. As prices rise, they reach the actual value of the asset. And something strange happens. Everyone begins to take risks.
So you notice the price has been racing up?
In the hope of making profits, they now trade high above the real value.
There's quite a frenzy, way above fundamental value.
In the flurry of buying, the students are now ignoring the fact that the asset will soon be worthless.
We're in period 10, and at the end of period 15, these assets are worth nothing.
As the end approaches, the price remains way above the real value. The graph has taken on a classic bubble shape. And when the players try to get out, no one wants to buy. Instead of earning hundreds of dollars, the students watch the graph collapse, leaving them with next to nothing. This experiment suggests bubbles may be part of the fabric of financial markets.
We've done hundreds of them now, and with all kinds of different subjects. How went to Chicago and I recruited some over-the-counter securities traders to put them in an experiment. They gave us a magnificent bubble.
Yeah, that guy's mustache, legendary. And his look, looks like a 1970s, something. Basically, guys, what happened, well, first of all, I'll ask you guys this. If you were in this experiment, what would you do differently? Would you, anyone who's confident enough, throw out an answer. How would you play it? Yeah?
I wouldn't invest at all because if it says that it will be worth nothing by the end of the game, it's better to have something that is worth something. Like
Yeah.
you have to trade it for something.
That is a strategy. You won't be the top. You won't make the most money in the class, but you're not going to lose anything.
Yeah.
But what I'll ask you is at the beginning, you'll notice that the actual asset value is going to decline. But in the very first second, the asset value is here, and you could buy it cheaper than the actual asset value. So there is still some edge to make. The way that I would play it, knowing how others were going to react, I would be the first one to buy. And if I'm not the first or the second guy to buy, I don't touch it. That's it. And after I buy, you'll notice what basically happened is it went up. This is going to happen to a lot of financial assets too, especially crypto. It goes up, it goes sideways as people just stop buying, and that's when your grandma buys basically. And what ends up happening is you want to be the first guy to sell. If you're not the first guy to sell, you're screwed. Because what's going to happen is the sell-off isn't going to be just like this. Typically, sell-offs are quick and violent, just like what you saw in that experiment. Again, buy before others buy, sell before others sell, and you'll make money. Recognize the mood of the market. Okay, here's another example, and this one is going to test your aptitude on risk. Okay? Here's an example, and you can probably figure this out if I give you guys a lot of time, but I'm giving you just 10 seconds. I'm going to ask you, yes or no, do you take this bet? There is a right answer, and there is a wrong answer. So I'll give you guys about 5 more seconds. What do you think you should do? Do you want to take it or no?
Take it emotionally, but not logically.
Why would you take it?
Come on, have some fun.
Have some fun?
Yeah.
Yeah? Yeah?
Expected value.
Yeah. All right, you got it. Yeah. Okay, so you know.
Minus,
Yeah.
2/3 times 15 is
Exactly. So you're probably already a trader, you know some gambling or some math.
Yeah.
That's the right answer. Yeah. So guys, the right answer here is you want to take this bet as many times as you possibly can. For the nerds like him out here, it's actually plus expected value. What am I talking about? Well, basically, here's what we know, guys. If we win, we make $10. If we lose 15. Now that by itself, it's not a great thing, and it's probably not a good risk to take. But there's a caveat. 2/3 of the time or 4/6 of the time, you're going to make that $10. And only 1/3 of the time, you lose 15. So your expected loss is going to be 2 out of 6 times 15, which is -5, and 4 out of 6 times 10, which to my knowledge is 6.666, repeating. When you combine those two numbers, you get an expected value of 1.66 per bet. The math in here, it's not important, guys. What is important is your understanding of risk. Risk is not at all always what do I gain and what do I lose. That's not how it works. There's a probability component that you got to understand. Now, before we go back to probability, here are some rules in trading that Ryan actually did a great job at mentioning. Number one rule that we talk about in crypto is don't lose your shirt. Now, that's not an anti-PSA for stripping. That's actually something that means basically don't bet at all, okay? Because if you bet everything you have and it doesn't go your way, you don't have any more way you can make money. You always want to be very careful and calculated in the amount that you bet. Risk versus reward and asymmetric risk. Asymmetric risk is by far the most important concept you should take away from this presentation before, besides the buy before others buy and sell before others sell. What is asymmetric risk? An example of great asymmetric risk is going to a job interview. The downside of that job interview is probably not that high. The risk, it's not that much. the reward is really high. You could get a job, or you could get an offer that gives you better value for other jobs and a higher pay. That's asymmetric risk. This example below is an example of asymmetric risk, and this example also illustrates all four. Here's how. If I gave you 100 trials to play this game, and you can bet as much as you want, here's how you would play it, and you would be almost guaranteed to make money by the end of it. 1, you don't bet at all. You know you have a good edge, but you do not bet at all on the first time because there's a 1/3 chance you could go broke. 2, risk versus reward. Your reward actually outweighs your risk because of the expected value of your gain versus the expected value of your loss. Is this an asymmetric risk? Meaning, is there an imbalance between your reward and risk? Yes, this is very positive, and this is something you want to do as many times as you possibly can. Go for gold. When I say go for gold, what I'm saying is when you find an opportunity with good edge, you've got to be aggressive. Sometimes I've had opportunities where I see something that looks good, but I just don't allocate a lot of capital to it. And then I hit myself because I'm like, oh, I only made like $2 when I could have made a lot more because I didn't really get aggressive enough. So when you have good edge like this, bet as much as you can without having major losses, basically, is the dominant strategy. This is a fascinating example that anyone who's been in crypto for some time probably knows, but here's how you make $10 million a day. This guy is Sam Bankman-Fried. He's the CEO of FTX, and I believe at this time he's the richest man on the planet under 30. He's worth $25 billion. Here's how he got started in 2017. He noticed that in US exchanges, Bitcoin was at about 10K, 10,000 US dollars. In Japanese exchanges, when Bitcoin was traded to the yen, it was at about 11K. Now what he did was he bought Bitcoin in the US, sent it to a Japanese exchange, sold it, and then sent those funds back, bought Bitcoin again, and yada yada. Essentially what he did is he made 10% per day. And how he really scaled this was he raised an $100 million fund. So he made $10 million a day. How did he do it? He spotted asymmetric risk. He spotted an opportunity where he could make 10% from buying Bitcoin in the US and selling it on a Japanese exchange, repeating that as many times as he possibly could, and now he's a multi-gajillionaire. So if you're able to find an asymmetric risk, first thing you should do is text me so that we can share it together. Your emotions in trading. Markets are not really a reflection of reality, as many of you guys know. They're a reflection of sentiment and emotions that we all feel. Now, here's a story that I do not like to tell, but I will tell it. It doesn't end well. I was in California 2 years ago with a buddy of mine, staying at his house, and I would wake up every morning, and to kind of show off, I would trade very, very risky. I would trade like high leverage, just betting a lot of money, and I'd make like $1,000 to $2,000 a day or more. And I thought I was a god. One day, I was not a god, and this happened. And a properly named ouch. I bought right up there, hoping that the price would rise and I would sell for a few $1,000s in profit. Price fell. I bought more. Price fell a little bit more. I bought more until it capitulated and killed my position, and I lost $23,000 in a day in cash. So that was by far one of the worst experiences I've had in my life, but it's something that taught me, that if you don't take risk into account, risk is going to take your head off. Before making any investment or trade, you've got to understand you're going to feel emotion. Even if you're a sociopath or you think you have no emotion when it comes to markets, you're going to feel something. And you're going to be motivated by how you feel. What you have to understand is that emotions of fear and greed are really going to dictate your decisions a lot of the time. But the best thing to do is to not think about yourself and about how you feel about fear and greed. But if you're advanced or want to be advanced, you think about how the market is looking at fear and greed. You can look at a certain market and say, hey, traders are getting greedy. Or a market falling and say, traders are getting fearful instead of you being fearful. And that kind of mindset is going to allow you to stay ahead of others. by recognizing their emotions. The best way to beat the emotional game, if you don't want to do that by looking at the mood of the market, is to have a plan. If you fail to plan, you're planning to fail. If you don't have a plan for how to get out, like me in California with my 23K loss, I just had a plan to win. I didn't have a plan to lose. If I lost, I was like, okay, I'll just lose. But that just lose cost me 23K. So don't be like me in that example. What you want to do is really, you either have set price points such as if I lose 20%, I'm out. Or if I make 30%, I'm out. That will work. Other things you can do is look at indicators, which I'm not going to talk about today, but it's a common way that people trade crypto. And if indicators reach a certain value, you exit or enter. That's a plan. Just buying and hoping to make some money or just show off, we all know how that ends. This is probably the best illustration of what I'm talking about today, of the mood of the market. Most beginners in any market, especially in crypto, they tend to buy euphoria. They tend to buy when the market is just rising like crazy and they think they don't want to miss out. Here's what ends up happening to your emotions and the emotion of the market. You buy at a high price. Price falls a little bit. You're anxious but not terrified. You know that it'll go right back up. Price continues to fall. You deny it. You go away from your charts. You just shove it away. You look at your chart again, and now you're beginning to get scared that you're not going to be profitable. Then price keeps falling and you get desperate. You panic, and now we get the most important stage, capitulation. Capitulation is the name for the stage that most beginners will sell. Most beginners, I'm sorry to say, sell market bottoms. And they do it because of their emotions. They think that the market's going to go to zero. And because of that, they end up selling. It's the same exact mirrored feeling of people who think a market's going to go to infinity or $1 million. That's euphoria. So this is where most people sell, and that is where most people will buy. Then what ends up happening is after you sold at capitulation, despondence, depression, because price begins to rise, and then some people begin to buy in right back here for it all to continue again. Now, that's bad news, yeah, but everyone in this room can take advantage because you now know how markets react. What you always want to do is be on the screening for euphoria. And if your friend calls you and tells you that this new coin is bound to go to $100,000 or $200K by the end of the year, be skeptical and potentially even look at trading on it going lower. If you see a lot of people capitulating and saying Bitcoin's going to go to zero, Bitcoin's going to go to zero, that's actually a phenomenal time to invest. That's when the elite investors step right in and scoop up at a low price. It's cutthroat, but it's really the best way and maybe even the only way you can make money if you want to do this successfully. This is a wonderful illustration of all of those emotions on Ethereum with today's price. Here's what happened. Optimism, excitement, thrill, euphoria. This is what euphoria looks like. Do you see how the price just went from about 2,800, 27 up to like 4,300 in a short period of time, a few days? That's euphoria. That doesn't last. People think it does because they see what's in front of them, but they don't know that if everyone's already bought, the market can't really go that much higher. Then what we end up seeing is look at just how violent that drop was. It was so violent that I wasn't even able to label my terms on the chart because it happened so quickly. Where do we want to buy? Well, the best time for you to possibly buy is in capitulation, despondency, and depression. I know that sounds like a PSA for like a, Lexapro or something, but essentially what you want to do is buy when people are freaking out like that and capitulating. Buy when they're despondent, when they're just so fed up with the market, typically a good time to buy. Depressed because it's rising without them. That's a great time. And if you hear people who are skeptical when a market is rising, a lot of the time, guys, the market continues to rise. A great example of this is actually outside of crypto with the US stock market. So many people are skeptical of the US stock market. You can find it anywhere in any article. What's happened in the US stock market? It has continued to rise. It does not care. How many people think it's going to fall? That's not how markets work. It's continuing to rise, and it will continue for quite some time until you get to a stage of euphoria or ultimate greed. That's what's going to end up happening. All right, going forward, any trade or investment you should remember, do not think about how you feel. The market doesn't give a shit about how you feel. Think about a tree. Timing. It's best to buy extreme pessimism and sell extreme optimism. We can also add one more level to this. It's better to buy disinterest and sell interest. When people are very interested in something and everyone's talking about it, sell it. When no one's talking about it and people think it's dying or dead, it's actually probably an asymmetric risk where you can buy something really cheap and the risk isn't that much, but the upside's a lot higher. Risk. Back to what I just said about asymmetric risk, you need to find opportunities that yield greater rewards than they do risks. Now, not everyone in this room is going to make 10 million in a day. I mean, if you do, send some my way because I kind of taught you how. But basically, if you find something that has great reward and not as much risk as it does reward, you got to go for gold. You got to execute and strike when the, I don't know what the saying is, strike when the iron's hot, something like that. Finally, your emotions, the hardest part. Have a plan, and you've got to understand the cycle of emotions that you're going to feel that come from price changes. Just because price is falling, it does not mean that price will continue to fall. Instead of that happening, think about how other people are panic selling and how you're either going to buy more or you're going to do nothing. Also, have a plan. Don't just do what I've done in my mistakes in my past, which is buy and hope. Buying and hope is the quickest way you can lose all your money. Seriously. You need to find asymmetric risk where the reward is far greater than the risk. You need to find something that is just beginning to rise or not many people are talking about it. And finally, you need to have a plan. If things don't go your way, how are you going to get out of this? And also, if things do go your way, how are you going to capitalize on it? All right, guys, that's it. So this has been a little trading crash course for all of you guys. If you guys have any more specific questions about more indicators and how I go day to day and how I make money, you can ask away, but hope this was helpful. Any questions?